Hello everyone. Today I want to discuss about one of the powerful concept used in trading to understand market sentiment. It is called the 25 delta risk reversal. When we trade options, we usually look at price, volume, and maybe implied volatility. But there is another layer of information hidden in option chains that give us a hint like what big traders are actually thinking, whether they are expecting upside or downside. And that's what we are going to discuss today. So at the end of this video, we will understand one more new concept, how big players read market fear and greed even before the price moves. Without delay, let's get started. First, what is this risk reversal thing? Before we jump into risk reversal, for everyone's benefit, let me explain a very simple concept, delta. Delta just tells us how much an option price will change when the underlying stock or index moves by 1 point. For example, if you buy a call option with 0.5 delta and Nifty goes up by 100 points, then our option price, otherwise premium, will increase by roughly 50 points. Simple as that. Now, call options have delta between 0 to +1 and put options have delta between 0 to -1. So, what is a 25 delta option? It's simply an option that has 0.25 delta, which means it has roughly 25% probability of expiring in the money. In simple terms, a 25 delta call is an out of the money call option that's relatively far from current price. A 25 delta put is an out of the money put option also far from current price. Both are equally distant from the at the money strike, so they make a perfect comparison. Now, what is a risk reversal? Risk reversal is very simple. It's just the difference between the implied volatility of 25 delta call and 25 delta put. If required, please pause and have a look at this formula. Risk reversal equal to IV of 25 delta call minus IV of 25 delta put. That's it. Very simple calculation. Just looking by option chain, one can easily say this, and by practice, traders can easily implement this. But why is this important? Because this tells us which side traders are paying more, upside or downside. See, if risk reversal is positive, it means call options are more expensive than put options, which means traders are willing to pay more for upside exposure. So, bullish sentiment. If risk reversal is negative, it means put options are more expensive than call options, which means traders are paying more for downside protection. So, bearish sentiment. So, in short, risk reversal tells us the directional bias of the market without even looking at the price chart. Let me give you a real example that played a major role in rupee's price action last week. We know last week RBI intervened very aggressively in the forex market to defend the rupee when it was closer to 89 rupees per US dollar. And if you look at the 1 month 25 delta USDINR risk reversal, it dropped to minus 0.8, which was the lowest value in over a decade. So, what does this mean? Before RBI intervention, traders were very scared that rupee would fall further, so they were buying USD calls, which is same as buying rupee puts, meaning they wanted downside protection on the rupee. Hence, the risk reversal was positive. USD calls were more expensive than USD puts. But after RBI's strong intervention, sentiment changed completely. Traders became more confident that rupee would stabilize or even strengthen. So demand shifted to rupee calls, which is same as USD puts. Hence, the risk reversal flipped negative, rupee calls became more expensive. So, just by looking at risk reversal, we could see the complete shift in market sentiment from bearish to bullish on the rupee without even looking at the USD INR chart. Exactly, that was happened last week. Rupee suddenly became stronger. In the last 10 years, it never happened. This is the power of risk reversal. Now, can we use this for Nifty and stocks? The answer is absolutely yes. I mean, this concept is very popular in currency markets where everything is based on country's macro and it is very simple, but it works perfectly for index options like Nifty and stock options like Reliance Industries as well. Let me show with real examples. At present, Nifty is trading at 25,868 and we want to calculate the next day expiry risk reversal. If required, please pause and have a look at the option chain delta. 25 delta call is roughly between 2600 to 2650 strike. So the IV would be around 8.77. 25 delta put is roughly between 25,600 to 25,650 strike and here the IV would be around 9.6. So risk reversal equal to 8.77 minus 9.6 which is minus 0.83 volatility points. So what does this mean? Here is the trick. If the risk reversal is strongly negative, like around minus 1.0 or lower, it means traders are aggressively hedging against downside, so bearish sentiment. If risk reversal is positive, it suggests call buying, so bullish sentiment. This is common near breakouts or short squeezes. Now we got the risk reversal minus 0.83, so strong negative, hence it's a bearish sentiment. I mean, most portfolio managers always monitor risk reversal shifts to gauge whether hedging costs are rising abnormally or not. For example, during result season or major macro events like Fed decisions or RBI policy, if risk reversal suddenly widens negative, it signals stress or uncertainty. Now let's look at a stock example. Let's take Reliance Industries. If required, please pause and have a look. From Reliance October expiry option chain with spot around 1465 rupees, 25 delta call is roughly between 1480 to 1490 strike. So the IV would be around 15.7. 25 delta put is roughly between 1450 to 1440 strike and here the IV would be around 14.7. So risk reversal equal to 15.7 minus 14.7 which is equal to 1 volatility points. It means call are more expensive than put, so investors are betting for more upside. This suggests bullish sentiment on Reliance, maybe because of the positive results. So in short, based on the risk reversal, it's signaling Nifty is negative but Reliance is positive. I hope everyone able to follow me. Here, please note, I'm not recommending to trade just based on this. Rather, I'm recommending to do the quick check before entering the trade. If required, please pause and have a look at this comparison table. In currency markets like USDINR, typical risk reversal ranges around plus or minus 1.0 to plus or minus 3.0 volatility points and the main drivers are central bank actions, capital flows and trade balance. Second, in index options like Nifty, typical range is around plus or minus zero point 0.3 to plus or minus 1.0 and the main drivers are macro data, FII flows and VIX. In single stocks like Reliance, typical range is around plus or minus zero point 0.5 to plus or minus 2. Main drivers are earnings, sector specific risk. But in all cases, the interpretation is the same. Risk reversal less than 0 means downside fear. Risk reversal greater than 0 means upside optimism. If required, please pause and have a look. This is the index risk reversal cheat sheet I developed. Please just take this as a pinch of salt. Don't trade just based on this. Trading is more of an intuition based art. One thing work for one person and it may not work for others. So I believe to be successful in trading, that individual has to create his own strategy. Anyway, here are the some limitations we should know. First, deep out of the money strikes may have unreliable implied volatility, so please be careful with liquidity there. Second, very short dated options like one day expiry can have erratic deltas, so some smoothing is needed in those cases. Third, during major events like interest rate decision, skews can change dramatically, so risk reversal alone won't capture the full picture. So, to summarize, the 25 delta risk reversal is far more than just as a theoretical concept. It's a powerful sentiment gauge that shows us actual market pricing of fear and greed. In currency markets, it reveals whether traders are hedging against rupee depreciation or betting on rupee strength. In indices like Nifty, it tells us if institutional investors expect a market sell off or a relief rally. In stocks like Reliance, it quantifies stock specific hedging pressure, often predicting volatility spikes before they occur. So that's all in this video. I hope you found this useful. Please consider subscribing to the channel and liking the video so that it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment decision based on this, as I'm not a SEBI registered advisor. I'm doing this for me and viewers educational purpose only. Thanks for watching.